The content of this document is divided into 3 sections. We will have a look at our intragroup transactions by means of examples, briefly touch on preference shares, and at the back will be a frequently asked questions section which will not be recorded. Now, before we look at our intragroup examples, I want to work through this schematic presentation of the different intragroup transactions. Now, you can get intragroup transactions where we have our trading inventory and our property, plant and equipment being sold between the 2 entities, and number 2, your intragroup balances. Now, when we look at the balances, this will normally appear on your statement of financial position. Therefore, this can be loans between the companies, transaction costs, transactions where we have to debit or credit the debtor-creditor intercompany, and bank accounts. But when we look at our intragroup transactions, this can be trading inventory. For example, where we have our parent that sells inventory to the subsidiary, or where we have our subsidiary that sells inventory to our parent. And always, you will have to remember this will have an effect on our analysis of owner's equity, because this will have an effect on the NCI. Now, when we have trading inventories between the 2 entities, there will be unrealized profit included in your closing inventory, opening inventory, and always remember the tax implication. Then please read your scenario carefully. There might be a write down to net realizable value. Or there can be a scenario where the parent sells property, plant and equipment to the sub, or the sub sells property, plant and equipment to the parent. Then the unrealized profit will be included in your non-depreciable assets, and your depreciable assets, always remember your tax implication. And please remember with this, the depreciation in the buyer's records. Right, now on a CTA level, you should be able to draft the journals where we have a transaction where our parent sells inventory to a sub, but in the sub's records, this is property, plant and equipment. Or it might be a scenario where our subsidiary sells property, plant and equipment to a parent, and in the parent's records, this can be inventory. Right. Now, I want to talk about the trial balances, and I want to ensure that you understand exactly what happens on consolidation process. Now, when you have to perform the consolidation, you will normally receive 1, your trial balance of your parent, which will be your assets and your liabilities. Therefore, always your trial balance have to net out to 0. You will receive your subsidiary's trial balance, the audited trial balance, and this will net out to 0. All of these figures should agree to the audited annual financial statements of your parent and your subsidiary. Right, now from a group point of view, you will have to add parent plus subsidiary to consolidate. Now, if you take this one step back, why do we perform our elimination journal of a subsidiary? If you think about your parent's trial balance, the separate records, the separate annual financial statement, if your parent purchase a subsidiary, they will have to debit investment in subsidiary. Therefore, you will have a line item investment in subsidiary. And let's say credit bank. This is a cash purchase, right? Now, if we add assets and liabilities of our subsidiary, we will add our equity of our subsidiary, and the equity will be included in our group records, right? Therefore, technically speaking, at the end, in our group, if you look at our group column, we will then double count for our subsidiary because we have our investment in subsidiary, and then we've included the share capital of our subsidiary as well as the retained earnings. Therefore, we include our equity as well as the investment. Double counting, right? But now, due to the fact that we have to include our elimination journal, we will debit our share capital of our subsidiary. Debit our retained earnings. Therefore, we will take this out. And we credit our investment in goodwill. Therefore, we will take out the investment in subsidiary, not investment in goodwill. We will take out the investment in our subsidiary. Now, very important, at the end of year 1, you will receive the trial balance of your parent plus the trial balance of your subsidiary. Then, at the end of year 2, you will receive the trial balance of your parent, plus the trial balance of your subsidiary. Therefore, if you have recognized your elimination journal in year 1, in year 2 you will have to do this again. Why? Because you receive a clean trial balance. What do I mean with clean? No consolidation journals have been processed yet. Therefore, you will have to process your elimination journal again. Therefore, if you have processed your intragroup transactions in the first year and there is still inventory included in the next year's trial balance, you will have to process this again. But it is important that you understand the retained earnings effect of this. Why? Because every year you receive a trial balance of the separate entity before consolidation.